Hey, nice to have you here again. If you are a new trader looking for a great market to trade your momentum strategies in, then you really have to learn to trade indices. These markets move nicely intraday and they provide lots of good opportunities for high reward, low risk trades. For instance, at the moment I'm looking at DAX there. It's been moving higher for 6 hours solid. Every hourly candle has been bullish. So these moves provide you with opportunities that you can learn to spot when you study the price action. But first you have to start somewhere. If you're a new trader, you need some education. So this video is the right place to start. We're going to take a look at the basics about indices and about indices trading. And then you can expand on this knowledge by going through some of the videos that we have on trading strategies. First of all, please do remember that we don't provide any investment advice and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. So, what are stock market indices? These indices are measures of the performance of a group of stocks representing a specific market or a sector. They are composed of weighted average, or I should say they are usually composed of weighted average of selected stocks and help investors to track the performance of what the stock market is doing. So basically you can compare your own portfolio's performance to that of S&P 500, for instance, so that you can kind of get an idea whether you should reallocate funds inside your portfolio to some stronger stocks if the market is moving higher, or you might want to drop some of the stocks and include more of those that are performing inside the S&P 500 index. Now, popular stock market indices are there to help you to understand what the economies around the world are doing, because the stock markets are reflecting what the economies do. At least they should. Yes, there are times when central bank policies sort of move the markets in sort of non-conventional ways. There was a time not so long ago when bad news was good news, because if the US economy was doing badly, then the investors expected that the Fed, the central bank, will pour money into the market and help it to move higher. So investors bought the market when there was bad news. The S&P 500, for instance, is a well-known, probably the most well-known index in the world. It represents the performance of 500 large cap US stocks and it serves as a broad market indicator. Then there are other indices like Dow Jones Industrial Average. It's sort of, in this basket you have 30 large US companies. And then FTSE 100, yes, that's tracking the 100 largest companies in the UK. And then Nikkei 225 does the same for 225 stocks in Japan. Then we have DAX 40 in Germany and Hang Seng in Hong Kong, so that you can have a very good idea of what these economies are doing if there is no central bank intervention, of course. Let's take a look at factors influencing index movements. First of all, you have earnings reports. The companies report earnings on quarterly basis and these reports tend to move the markets. So they impact individual stocks, but they can also impact the overall market sentiment. So if the earnings reports come in better than the analysts have been expecting or projecting, then it's likely that this is a bullish signal. Then economic indicators, you have macroeconomic data, like payrolls data, for instance, or inflation data that impacts the index movements. Then we have geopolitical events, wars, For instance, we have at the moment the famous war in Europe, the Ukraine war going on. So this influence, especially in the beginning of the war, was quite severe. You could see DAX moving strongly up or down based on what was happening in Ukraine. So they influence geopolitical events, influence market volatility and investor sentiment. Let's talk about pros and cons of trading indices compared to individual stocks. So the benefits of trading indices include, first of all, diversification. As trading an index provides exposure to a basket of stocks, you are not exposed to individual stock risk. So company-specific news or events don't usually impact your trading when you're trading indices. The other benefit is that the spreads are really tight. So that sort of lowers the cost of trading, lowers the cost of running the trading business for you. And then the third point, the high liquidity means that there is less slippage in the market. You can usually always get your trade executed at the price that you wanted. Now, there is the sort of downside to trading indices is that the potential for extraordinary gains is quite limited. Indices don't move like stocks. Stocks can move sometimes 10, 15, 20% overnight, especially if there are company-specific news. But then these can work against you as well as for you. So it might be actually better to trade indices. And because of high liquidity in the indices, you can have higher leverage. Obviously, you first need to know what you're doing. If you're a newcomer to the market, as you probably are watching this video, I would advise you to not trade leveraged positions, but just stick to demo trading first and then start with non-leveraged trades. And then later on, when you know more and your skill set is much better, then you can start adding leverage to your trades. You might be asking what technical analysis tools you can use when you are trading indices. And the good news is you can use the same technical toolkit that you are using in any other market. So you can use support and resistance levels, moving averages, oscillators, etc. Whatever you are using in the other markets, it also works in indices. Let's go and take a look at the charts. Here I have S&P 500 in the 8-hour time frame. So it means that each candle here represents price action for 1 8-hour period. And as you can see, here was a level that market found support and then it rallied strongly. So let me illustrate what could happen when something like this occurs. So the market reacts lower, hesitates a little, then moves down even more, and now it's approaching the support level. It slightly penetrates the level before bouncing higher. So this is a time where you might want to consider taking long trades with the view of market moving higher from here. Let me also give you an example of a resistance level. Some people want to be aggressive in the market, and even if the market is making higher lows and moving higher, then they might take a contra trend position by shorting the market at a resistance. So here we have the recent high, and when the market moves to this level, what traders usually do, they wait to see if the market starts to reacting to the level. So this means that they are not acting alone if they go short. And in this situation, the market really loses momentum and fluctuates sideways for some time before moving lower. But remember that if you consider taking short trades like these, you need to be cognizant of the fact that the market is actually in an uptrend. So it could mean that these the down moves inside an uptrend don't last that long. And eventually the market moves higher again. In addition to support and resistance levels, traders also use moving averages to highlight when the market is moving either up or down. So when you have two moving averages on your chart, for instance, in this S&P 500 chart, we have a 20 period on red and 50 period on blue. When the fast is above the slow, the market is likely to move higher. When the order of the moving averages is the opposite, the market is more likely to move down. And when you see the price chopping on both sides, the moving averages, and the moving averages are in the middle, then the market is most likely in a range, like here. When trading indices, you can also use stochastics or other oscillators to point times when there might be value in the uptrend. So if you look to buy the market when the moving averages are pointing higher and the red is above the blue, so the slow is below the fast, and the stochastics oscillator is close to or inside what's known as oversold area, then you might want to be a buyer in the market and catch the next move higher. So when you are analyzing indices, you want to obviously have a full picture of what's happening in those markets. So on top of analyzing the technicals, you want to follow what's happening in the macroeconomic side. So the fundamental analysis considerations for index trading include analyzing macroeconomic factors like employment or inflation. You are looking at industry trends and market cycles, because all of these indices, stock indices, they basically can be divided into sub-indices or sectors. If you understand what's happening in the technology sector or financial sector, and then you can understand how much those factors impact the index on, or the markets on index level, then you are more prepared to make the right decisions. Then you want to evaluate the impact of the central bank policies. So whatever happens with the monetary policies, you obviously want to know what's happening there, and then you want to follow the market to see how the market reacts to what the central bank is expected to do or says it will be doing. Because your opinion or some analyst's opinion on what the Fed is going to do doesn't really matter. What matters is how the market reacts to this information, and how then you can decide how you can trade the market accordingly. Okay, next I want to talk to you about the common mistakes that you should avoid when trading indices. The biggest problem with losing traders is that they neglect risk management, and I've never heard of a successful trader who has made his or her millions by trading the markets without risk management. So just stick to your risk management plan, write it down on paper, never deviate from it, and you'll be successful. Sooner or later, you'll be successful if you keep on doing the right things and avoid mistakes. Then emotional trading decisions based on short-term market fluctuations, they really tend to hamper your trading career or your advancement in your trading career. If you are angry, if you are greedy, if you are fearful, all of these emotions, it is a scientific fact that these emotions will diminish your mental capability, and then it leads to really bad trading decisions. So if you're angry, that means you are actually dumber than normally. Don't trade when you are angry. So then thirdly, too high leverage. Most traders are greedy, so they start trading with huge trade sizes, and they soon find out that they can't handle those, or their strategy isn't good enough, so their accounts get wiped out. And also, if your leverage is too high, meaning you have too big positions relative to your account size, it means that your mental capacity or your mental capital is quite soon burned out. So imagine if you have a series of losing trades and you lose something like 30, 40, 50 or 60%. It's really difficult to recover from that sort of drawdown. A drawdown of 10%, 15% or 20% is okay, but when it gets close to 50 or 60, then it's really difficult because you have to make 100% to get back to the break-even level. So make sure you are using small leverage, and only when you have been trading for longer you start increasing your trading size. Your trading statistics have to be so good that sort of bigger trading size is justified. Then number 4, changing trading strategies constantly. This is a big mistake a lot of traders do, especially new traders and losing traders, because every strategy has good periods and bad periods. So if you keep on changing your strategy each time you have some losing trades, then you never gonna make it. You end up chasing something that doesn't exist. You end up chasing a perfect trading system, and you fail to develop yourself to such a level where you can execute one trading strategy flawlessly. So make sure you have a good trading strategy, back-tested with historical data, and once you know that it has a positive expectancy so that it over time makes money. Say you take 200 trades or 1,000 trades and it makes money or enough money to cover the losing trades and the trading fees. Then you have positive expectancy. So if you find a strategy like that and stick to it, then you'll be fine. You just need to learn bit by bit, day by day, and you're gonna make it one day. Hey, it was great to have you here. I hope that you found this video helpful, and if you have any questions related to the topic, please feel free to leave them in the comments below, or you can always email us on support@tiomarkets.com. Take care, see you soon on the next video.